Hey everyone, welcome back to Fiscal News. If you're interested in finance, markets, and the forces shaping our global economy, you're in the right place. Today, we're diving into something that's changing the game for small businesses everywhere: how artificial intelligence is reshaping credit decisions for SMEs. That's it for today's deep dive into how AI is transforming credit decisions for SMEs. It's clear that the future of lending is evolving, and fast. What do you think? Should we trust AI to make these crucial financial decisions, or do we still need the human touch? Let me know in the comments. I'd love to hear your thoughts. If you found this video useful, don't forget to give it a thumbs up, subscribe for more financial insights, and hit that bell so you never miss a post from Fiscal News. Until next time, stay informed and stay ahead. Let's move on. AI, a major shift is underway. AI-powered models now process vast amounts of financial and non-financial data to make lending decisions faster and potentially more accurately. But is removing the human factor from this process truly a good idea? Can AI improve credit access without introducing new risks? Let's explore how AI is revolutionizing SME credit decisions, the pros and cons of this shift, and whether a fully automated system is a realistic or desirable future. How banks traditionally assess creditworthiness. For decades, banks have relied on conventional methods to evaluate the creditworthiness of SMEs. These methods generally fall into four key categories. Financial statements analysis: lenders examine balance sheets, income statements, and cash flow records to determine an SME's financial health. Credit history: a company's past borrowing behavior, including loan repayments and defaults, heavily influences approval decisions. Sectoral evaluation: the industry in which the SME operates matters. For instance, tech startups may be perceived as riskier than established manufacturing firms. Human interpretation and relationship banking: in many cases, experienced loan officers assess qualitative factors such as business reputation, leadership strength, and local economic conditions. This traditional system, though thorough, has drawbacks. It is slow, prone to human bias, and limits access to credit for SMEs without an extensive financial history. Additionally, subjective judgment can lead to inconsistent lending decisions. AI versus human judgment in credit decisions? While AI improves efficiency, it also introduces significant challenges. Comparing AI and human judgment reveals both strengths and weaknesses. Advantages of AI in lending. Speed and efficiency: AI can analyze thousands of data points in seconds, expediting loan approvals. Reduced human bias: AI makes objective decisions based on data, potentially eliminating discriminatory lending practices. Improved credit access: AI can approve credit for SMEs that traditional models might reject due to a lack of historical financial records. Limitations of AI in lending. Lack of contextual judgment: AI may reject creditworthy SMEs if they don't fit its predefined patterns, ignoring qualitative business strengths. Algorithmic bias: AI models are only as unbiased as the data they are trained on. If past lending decisions were biased, AI can reinforce those same biases. Black box problem: AI decisions can be difficult to interpret or challenge. If an SME is denied credit, it may be unclear why. For these reasons, some argue that AI should complement, rather than replace, human judgment in lending decisions. How AI is entering the credit decision process. AI-powered lending platforms are rapidly transforming how banks and alternative lenders assess creditworthiness. These systems leverage big data, machine learning, and predictive analytics to process applications in real time. How AI works in credit decisions. AI models analyze a broader range of data than traditional credit assessments. Key elements include alternative data sources: AI incorporates payment behaviors, online transactions, supply chain relationships, and even social media activity. Machine learning algorithms: these algorithms detect patterns in borrower behavior, enabling lenders to predict repayment probability with higher accuracy. Automated risk assessment: AI assigns risk scores based on historical and real-time data, reducing the need for manual evaluation. Several fintech companies, such as Zest Finance and Upstart, already use AI-driven credit models to approve loans for SMEs that might have been rejected under traditional systems. Should we trust AI for credit decisions? AI is undoubtedly revolutionizing SME credit assessment by increasing speed, efficiency, and accessibility. However, the complete removal of human judgment is neither practical nor ethical at this stage. A balanced approach, where AI assists human decision-makers rather than replacing them entirely, is likely the best path forward. As AI technology evolves, the challenge will be ensuring that automated systems remain transparent, fair, and adaptable to the diverse realities of SME businesses. The key question remains: are we ready to let AI determine the financial fate of millions of SMEs? While AI's potential is immense, human oversight is still essential to ensure responsible and inclusive lending practices in the future.